So we said credit multiplier is a process through which we will understand how commercial banks create money, right? Is the process. So let me write that down for you. Is the concept that explains, is the concept that explains, that explains how commercial banks create money. Right. And what are commercial banks? We know commercial banks are the private banks that are there for profit maximization. How commercial banks increase money supply, right? So this is basically the definition of credit multiplier. Increase money supply. Now think about this. What is money nowadays? Now, this is very important for you to understand, right? So money is anything that can help you to buy goods. You know, let me repeat that. First of all, what is credit multiplier? So we have just looked at and discussed the definition of what credit multiplier is. So credit multiplier is a concept that explains how commercial banks increase money supply, right? How commercial banks increase money supply. And what is money supply? So money supply is anything, money is anything that can help you buy goods and services. Anything, basically it is the transactionary motive that has to be met, right? Anything that helps you to buy goods and services. Anything that helps you buy goods and services, right? So this is what money is. Okay. Now this being said, think about this. Cash is one form of money, right? So now in today's class, we'll also talk about the types of money supply. So there are two categories of money supply. One is known as narrow measure of money supply, and the other one is known as broad measure of money supply, right? So far, what is money? Obviously, it's important for us to understand what money is. So money is anything that helps you buy goods and services, right? So this can include things like cash. Bob, do you agree with me? So obviously, currency or cash is one form of money, right? But that also includes few other things. Now, it also includes some other things that we are using nowadays. Debit and credit cards. So think about this. Even though this is not cash, but this is good enough for anyone to buy goods and services. So I go to a shop, I have to pay for the thing that I have bought. Then either I can use the cash or I can just give my debit card, right? My debit card would be good enough to buy me the goods and services that I need, right? So cash, debit and credit cards, and think about this. And loans. Think about this. What is a loan? Basically, loan is the amount of money that the bank has borrowed you, right? Has lend you, right? So loan is the amount of money that the bank has lent you, right? And then you can use that money. And after that, sometime you have to return that money to the bank, right? Now, listen to this very carefully. So if I go to bank to take a loan, right? It will take some time, obviously, as I was telling you yesterday, that the bank will, undergo their security check. They will, do background screening. They will ask for my financial documents. They'll ask me what is the purpose why I need the loan and all these things. After they have done their homework, after they have verified me as a consumer, they will either approve my loan or they will decline my request. If they approve my loan, what happens? Now think about this. Now this is very important for you to understand. If they approve my request for loan, so I will have obviously some bank account. So that bank, it might be the same bank in which I have the bank account, they will transfer a certain amount of money to my bank account. So let's say I've taken a loan from Standard Chartered Bank, you must have heard the name about it. And they transfer, let's say 1 lakh rupee or whatever the amount of loan is to my bank account, right? Now it is just a digital, transaction. It's just a digital transaction in the sense that there's no physical transfer of cash, right? Are you getting me? So what I'm trying to help you understand over here, that the way banks work nowadays, it's all about digital money. Digital money is that, think about this, even when I pay through the debit and credit card. Now, this is very important, Bob, so you have to pay close attention. So when I go to shop, a departmental store and buy something. Let's say I go to I don't know, fuel station, and I ask them to pay for five and put 5,000 rupees worth of fuel in my car. They do that. I give them card. They bring their machine, and then they insert the card in that machine, and so on and so forth. And then automatically 5,000 rupees are deducted from my bank account. 5,000 rupees are deducted from my bank account. So if previously 95,000 was lying in my bank account, now I only have 90,000. So it doesn't mean that my bank will go and physically take 5,000 rupees and they give it to the other bank. It's not like that. It's just a digital transaction that 5,000 will be decreased from my bank account and 5,000 will be added to the other person or the fueling station bank account. Are you getting me? Okay, now let's do a quick recap. Isha has just joined us. So let's do a quick recap, students. So today we'll try to do analysis about what is credit multiplier, even though we did talk about this in the last class, but we could not do much of the analysis, which is very important here, right? So we will analyze how credit multiplier affects the money supply, increase the money supply of an economy, right? So the first thing that you need to understand that what is credit multiplier? Credit multiplier is the concept that explains how commercial banks increase money supply. How commercial banks increase their money supply. Now, what are commercial banks? That's an important question to ask. We already know that commercial banks are private banks that you see here and there, everywhere, right, around you. And these are profit-making entities. These are profit-making entities. These are private businesses, and they will try to maximize their profit. This is what commercial banks are, right? So Standard Chartered, Allied Bank, Habib Metro, HMCB, Muslim Commercial Bank, and all these are commercial banks, right? Now, okay, moving forward from here, students, have a look at this. Anything, what is money? Then we discuss that what is money. So money is anything that helps you buy goods and services, obviously, right? So the simplest and very accurate, most accurate definition of money would be anything that helps you buy goods and services, right? Transactionally motive. What is the most important purpose of money? To buy goods and services, right? Now, I was telling you that cash is money, obviously, because cash is currency notes. I go to shop to buy something small. I take my wallet along. I have some cash lying in my wallet. I go there. I buy goods worth 50 rupees. I take out the 50 rupee note. I give it to the shopkeeper and take the good and leave, right? Then another thing that is money nowadays, debit and credit cards. Now, this is the thing that I was giving you the example of. You go to shop, your parents go to shop, they buy something, instead of paying in cash, they give them the card. So the shopkeeper takes out this small machine, puts your card in that machine, and your amount is deducted and added to that person's bank account. Now, this is a digital transaction. This is e-money, right? Digital payment, e-money, these are all the different names for this. Now, in this case, there is no physical transfer of cash. There is no physical transfer of cash. It's not that your bank will take 5,000 rupee note and give it to the bank in which you have made the payment. No, it doesn't happen like that. So it's just that your bank account will be deducted by 5,000 rupees, and the shopkeeper to whom you paid, that person's bank account will be increased by 5,000. And it's just a balance. It's just a balance, right? Are you getting me, students? Are you following me? Similarly, loans are also a form of money. Now, loans are also a form of money. Why is that so? Listen to me very carefully. I go to bank to take a loan. I was explaining you yesterday how banks operate. So it's not that every person that goes to bank to take, to request for a loan, bank will always give a loan. No, that's not how it works. Bank has to make sure that the person who is borrowing is trustworthy, that person will return the money, and so on and so forth, right? Now, if I go to bank, I make an application for 1 lakh rupees loan. So I make an application for 1 lakh rupees loan, right? I will look at this, right? So bank will ask for financial documents. They will ask me some questions. They will, look at my financials and all that things. They'll ask me why I need a loan for and blah, blah, blah. In case my loan is approved, they will transfer 1 lakh rupees to my bank account, right? Let's say I have my bank account in Standard Chartered Bank, right? So Standard Chartered Bank will increase my bank balance by 1 lakh rupees, because that is the amount of loan that I took, right? Now I will use that amount of money, right? As soon as I receive the loan, I can take out cash from the ATM card, just like it happens normally. I can give this 1 lakh rupees in check. I can give this amount of money in check to any person to whom I need to make the payment, right? So let's say if I have to make the payment to, let's say, XYZ, my friend or whoever, right? I pay this check to that person and that person can use the money, right? Right. Right, so that varies. And also they have different categories. They have very organized system. They have different categories. So to give you a quick example, right? So they have personal loans. Personal loans start from 1 lakh rupees to, let's say, 1 lakh rupees to maximum of 20 lakh rupees, right? In some cases, some banks offer personal loans from 1 lakh rupees to 30 lakh or 40 lakh rupees, right? That is personal loan. Then similarly, there is other types of loan, home loans. Home loans are bigger amounts because obviously home is much more expensive and so on and so forth, right? So they have all these different categories and they have defined it already that, you know, what is the maximum amount that you can get and so on and so forth. So they have all these things sorted. Right? So this is how it basically works. Right? Okay. So students, are you getting me? So what I was trying to say over here that loans also act as money. Why? Because if I get that loan from a bank, my bank balance will increase, and then I can use that money, like either I can take out cash from the ATM or I can give a check to someone to whom I need to make the payment and so on, right? So that also helps me buy goods and services, right? Now think about this. Now coming back and linking all of this to credit multiplier. Now what was credit multiplier? We'll do a quick recap and then we will exactly see that how credit multiplier is increasing money supply because they're issuing loans, in the economy that increases money supply. Now before we move forward from here, transfer to our account, right? They are transferred. Sometimes they are cash. Sometimes they transfer to your bank account. Yeah. And then you can either take out the cash or you cannot take out the cash. You have to use the checks. I mean, there is different requirement for each loan, right? So for personal loans, they are smaller amount. You can also take out the cash from the bank if you need to, but what is that called? The other loans which are of bigger amounts, you can't take out the cash because think about it. If the bank is giving you loan for, let's say, 2 crore rupees for a home loan, right? So you can't withdraw the cash and it also doesn't make sense, but you can make your payments through loans. So it depends on what type of loan it is and what are the requirements for that. So the transaction with no physical transfer have any influence on money supply? Yes, totally. Isha, that is increasing your money supply because think about this. Now, Isha's question is that if there is no physical transfer of cash, will the money supply increase? Yes. Don't think of money only as cash. Back in the day, yes. Back in the day when, you know, everything was cash transaction. Yes. Then obviously you are right that money supply will only increase when when the central bank is issuing more currency. Until unless they don't print more rupees, money supply will not increase back in the day because everything was a cash transaction. You go to shop to buy something, you have to pay in cash. But that has changed since then, right? Now you're making digital payments. As long as your transaction can be made, you can buy the goods and services that you need, then your money supply will increase, right? Now have a look at this. Think about this, right? Now, what was credit multiplier? So we said credit multiplier is that there's a bank, right? Quickly have a look at this. So there's a bank and bank has always two types of customers. One type of customers are the ones who are depositing their money in the bank. So they are known as depositors. The other type of customers of a bank are the people who want to take loans from a bank, right? So they are depositors and borrowers, right? Now, the way banks operate, that they charge increasing money supply is not good. It causes inflation. It does. We are coming to it. Related to broad and yes, we are also coming to that, right? So have a look at this. So students, borrowers pay interest to the bank and some of that interest is paid to the depositors. So if bank is charging, let's say 10% interest to borrowers, let's say 4% is paid to depositors and the remaining 6% goes to bank's pocket, right? This is how banks make profit out of it. Now moving forward, the thing is that if let's say the total amount of deposits that are available to a bank is X amount, what we looked at yesterday, right? And yesterday we took the example of 100 billion, rupees. So if a bank in Pakistan has 100 billion rupees worth of deposits, the bank will divide this money into categories. The bank will divide this money in two categories. One is known as reserves or liquidity ratio. This money is not available to issue loans, right? And who tells how much will be the liquidity ratio for each bank? It is the central bank. It is the central bank that that decides how much will be the liquidity ratio or how much will be the reserves for a bank, right? Now, this being said, right, exactly, available cash. So cash available to pay back to the people, depositors who have deposited in your bank, right? Now, the second group of funds is known as amount available for issuing loans. So the second category is known as amount available to issue loans. Available to issue loans. Okay, think about this. Now, let's say yesterday, the example that we were doing, let's say 50% is the liquidity ratio, which means half of the total deposits. Half of total deposits cannot be used to issue loans. And therefore, it means that the remaining half is available to issue loans. Remaining half is available to issue loans, right? Now, out of 100 million, 50 million will not be used to issue loans, and the remaining 50% would be. What is the formula of credit multiplier? We looked at it yesterday, and let's quickly look at it again today. So credit multiplier is simply 100 divided by liquidity ratio. Credit multiplier is 100 divided by liquidity ratio. So it would be 100 divided by liquidity ratio. So that would be 50 in this case, and that gives you 2. That gives you 2, right? Okay. Now 100 divided by 50 gives you 2. This is showing you what? Sorry, 100 divided by 50, right? So this credit multiplier of 2 shows that the amount that is available to issue loans, 2 times of that amount can be issued for loans. I repeat myself. 2 credit multiplier shows that the amount that is available to issue loans, 2 times of that can be used to issue loans. 2 times of that can be used to issue loans. Exactly. Perfect, right? So this means that 100 billion worth of rupees, because 50% of this would be 50 billion and 2 times of that would be 100 billion. So 100 billion worth of loans can be issued. And then we looked at another thing, that lower the liquidity ratio, more the amount of loans that banks can issue, right? We did look at this. So if you repeat the same example with the lower amount of liquidity ratio, like instead of 50%, if you use, let's say, 20% or 25%, you will see that the amount of loans eventually, that is, the amount of loans that are eventually issued will be greater than, in this case, lower the liquidity ratio, right? So this is what you need to remember. Lower the liquidity ratio, higher the amount of loans issued, higher the amount of loans issued, right? Is it simple? Any confusion so far? Okay, now moving forward from here, students, Okay, now this is what credit multiplier is. Now we just talked about that money is anything that helps you buy goods and services. Now here comes in the 2 definitions, or 2, as I would say, 2 measures of money supply. So narrow measure of money supply and broad measure of money supply. So once you understand this, you will get a better idea of what we are talking about, right? Satisfy needs and wants. Exactly. So money is exactly anything that helps you buy goods and services that you need to satisfy your needs and wants. Now, measure of money supply. Measure of money supply, right? So there's broad measure and then there's narrow measure. So for the narrow measure, yes, you're right. In narrow measure, we only look at how much is the cash available in the country. Now listen to me very carefully. In case of narrow measure of money supply, it is only looking at the amount of currency or the cash that is circulated in the economy. Narrow measure of money supply only looks at the cash. Narrow measure of money supply only looks at how much of cash or currency is available in the country. That's narrow measure of money supply. As far as the broad measure of money supply is concerned, it not only looks at the amount of cash that is available, but it also looks at the total amount of loans that banks issue. Broad measure of money supply. Students, are you getting me or not? Are you getting me? So just give me a second. Just a second. Okay, is this making sense, students? Okay, yes, I'm coming to it. Let me also write down the definitions. Okay, now here's the thing. So students, the question is that how do we define money? Initially, I gave you a very simple definition. I said that anything that helps you buy goods and services, that is money. Initially, when we started the class, I gave you a very simple definition of money, and that was anything that helps you buy goods and services is money, which is correct, right? But then from economists' point of view, or the policy makers' point of view, it's important to divide that to be more specific, right? So from economist point of view or the policy makers' point of view, it's important to be more specific. Therefore, they divide money supply into categories: narrow measure of money supply and broad measure of money supply, right? For the narrow measure, the definition is includes cash that is lying in people's wallet and deposited in banks. So basically, it only includes, the narrow measure only includes the cash, the amount of cash, currency that is being circulated in the economy. It includes cash that is lying in wallets and deposited in banks. Are you getting me? So this is exactly what we were talking about, that cash is either lying in our wallets, like all the Pakistanis, how much cash is lying in their wallets, right? For their day-to-day transactionary motive, right? Do you remember that? And deposited in a bank. Like basically, long story short, the total amount of currency that is available in the country, that is your narrow measure of money supply. The total amount of currency, cash that is available in a country, that is your narrow measure of money supply. That is what you need to remember. Now, as far as the broad measure of money supply is concerned, that would include cash in circulation, which basically includes all of this, which basically includes cash, includes all of this. Narrow measure includes cash in circulation plus the amount of loans, cash in circulation plus the amount of loans created by commercial banks, plus amount of loans issued by commercial banks. Right. Students, are you getting me? Is this simple? So this is what broad measure of money supply is. Easy? Any confusion? Anything that's not clear? Right? So now when we look at the broad category, we know that money supply would increase when commercial banks issue loans, right? Includes bonds or anything else. We are coming to it. That's another thing, right? Exactly. That is indirectly affecting money supply, Ishanadi. So that is a concept called open market operation. So that is also part of the syllabus. We are slowly building towards that. But bonds themselves are not money. Bonds themselves are not money, but they are used to influence the money supply. Now, are you getting me? This is very tricky. So loans in themselves, think about this. Loans in themselves are money. Loans in themselves are money, because how so? When the bank has issued a loan to me, technically that amount has become available in my bank account to go and buy whatever I need to. I repeat myself, right? So when bank issues a loan to me, that amount gets transferred to my bank account. And let's say I took that loan because I need to buy a new house, right? So I go and give that loan amount that is lying in my bank account as a check payment to the contractor who will build my house, right? Are you getting me? So that is helping me buy goods and services. Yes or no? Now, bonds are not like that. So cannot be, bonds can be converted into cash, but bonds are an instrument that influence the money supply, which we will see in a bit, because with bonds, the central bank issue bonds to reduce money supply, and then it repurchases those bonds. So this is getting a little complicated, I know. Central bank initially issues bond to reduce money supply and vice versa, right? When it purchases back the bonds, the money supply increases, but we'll look into it, right? Are you going to use bonds an instrument through which you influence the money supply? I'll tell you how. Okay, now students, have a look at this. Includes cash in circulation plus amount of loans issued by commercial banks. Is this making sense? Is this making sense? Okay, now moving forward. Arbab, are you with us? Okay, now when we say that how credit multiplier increases money supply. Now, the question is how credit multiplier increases the money supply. So it does increase the money supply because it's increasing the amount of loans. It's increasing the amount of loans that banks are issuing. Yes or no? So that is how it's increasing the money supply. Now comes in the concept of bonds and how bonds are used to affect the money supply, right? And with this, we will come towards completion of our credit multiplier topic. Now, students, think about this. First of all, try to understand what are bonds. What are bonds, right? So even in bonds, there are different categories. Some bonds can be converted into cash. Some bonds cannot be, I mean, before the period, you cannot convert that into cash and so on, right? So the way it happens is bonds are issued by government bonds we're talking about. They are private bonds like corporate bonds, and then they are government bonds. But for our purposes, we will only be talking about the government bonds, right? Now think about this. So simplest idea of bonds is, now listen to this carefully. So when an institution issue bonds against that bond, it is raising a loan, right? Bond is an instrument used to raise loan. How so? Let me tell you. Now, please pay attention to the terminology I'm using. Bond is an instrument used to raise loan. Bond is an instrument used to raise loan. Now, how does that work? Think about this. Now, when governments, let's talk about government bond because that would be much easier to understand. When government issue bonds, right? So that bond has a face value. That bond has a face value, 5,000 rupees bond, 10,000 rupees bond, 40,000 rupees bonds, and so on and so forth. Normally, this is the face value, right? So let's say if I buy that 25,000 rupees bond. Now, students, pay close attention. So if I buy only one 25,000 worth of bond, so what will I do? I will take that certificate. So bond is kind of a certificate, a piece of paper. I buy that bond and pay 25,000 rupees to the bank, right? Because normally government executes this through commercial banks, right? So if I go to Standard Chartered and I see, oh, government is issuing bonds and government bonds are very safe and secure. So I have some extra cash that I want to invest. So I buy that bond for 25,000. So why I as an individual would be interested in buying a bond? Now, this is a very interesting concept. Think about this. So after 1 year, the way it normally happens is after 1 year, so there are price bonds on which I have a chance of getting a price bond, right? That's a different thing, right? I can get some additional amount if I win the prize. And otherwise, the way it works is it gives you interest. So after 1 year, I will get my principal amount back, which is 25,000 plus. After 1 year, I get the principal amount back plus the interest. So why as an investor, we put our money in a bank, or why do we why do we do any investment? Because we're looking for more return, right? We want to get our principal back plus interest, right? So, or you can say profit or whatever word you're more comfortable with, but the bank after 1 year, sorry, the government bond, you will be able to sell that bond after 1 year to the government, and the government will give you back this principal amount, which is 25,000, And they will also on top of that give you interest. Let's say if the interest rate was 5%, so that would be how much is 5% of 25,000, right? So you do the simple maths. So this gives you 0, 5 5s are 25, 5 2s are 10, 11, 12. So 1250. So they will give you 25,000 rupees back plus 1250 additional. Are you getting me? Is it simple? Right? So this is how the bond system works. So what was the purpose of a government to issue bonds? Students, are you with me or not? Why am I explaining you in detail? Because otherwise, the next thing that we will do, open market operations, you will not be able to understand until you know what a bond is. So bond is an instrument used to raise loan. Who is raising loan? You should be asking yourself this. Who is raising loan? Come on, tell me. Who is raising loan in this case? Who can tell me? Come on, students. Is this confusing? Ask me the question. We want to complete this in today's class. So government is raising loan. And why do government need to raise loan? Government need to raise loan because government might have some upcoming expenditures for which it needs to make the payment for. Right? So governments always have two options to get a loan from. Either the government can raise loan locally or the government can take an international loan. When Pakistan's government think of taking bigger amount of loans, which obviously has to be an international loan, it will go to World Bank, IMF, and so on. Right? Are you guys getting me or not? Or go to some wealthy countries like USA, UK, Germany, so on, blah, blah, blah. Another way that a government can take a loan is from its own citizens. Government can take loans from its own citizens, like its own residents, right? Arbab, are you getting me? So this might be a new concept for you. Right, exactly. So taking loan from IMF or World Bank is obviously what happens most of the time, because obviously World Bank can issue billions of dollars of loans, right? Because it's a big institution. IMF can do the same. But sometimes the government might not have this huge amount requirement, right? So they're looking to raise a loan locally. Locally from whom? From us, we as people. And this is not only happening in Pakistan, this thing happens in other countries as well, right? So US Treasury bills, you might have heard about it. US Treasury bills are basically US government bonds, and they issue that bonds to the public buy those bonds, and then they raise a loan for a certain amount of period, let's say 5 years, 10 years, or whatever. Government with that money executes whatever, targets it has, like making infrastructure projects or doing other things, and so on and so forth, and then return the money back to the people, Are you getting me? Students, is it simple? Now, that's why I said, what is loan? Loan is an instrument used to raise loan, right? Now, government issues bond, right? And bonds have different amount of values, 25,000, 40,000, 50,000, but I don't think so it goes anything above 50,000, right? So let's say this bond goes to individual, and individual pays 25,000 or 50,000, or whatever the amount of worth of bond it is, right? Now, what is the incentive for the individual? First things first, what is the incentive for the individual to buy a bond? So just like you deposit your money in a bank account, like a saving account, and what is the incentive you have? You have the incentive that after some time, you will be able to, you will be able to withdraw your principal, and on top of that, you will also get interest. So that's one, obviously, main incentive for you, right? So similarly, when you buy a bond, you get your principal back. If it's 1 year bond, after 1 year, you get your principal back plus interest, whatever it is, 5%, 6%, 7%, that varies, right? So that is why people buy government bonds. Exactly. The government will be lost when it has to pay back. No. Whenever anyone takes a loan, I totally get what you're saying, that the government is in loss because they have to pay interest. But this is what they would have faced even if they would have taken a loan from World Bank or IMF. So even if they would have taken a loan from World Bank or IMF, they would have been in the same situation, right? Are you getting me or not? So that is what you need to understand, right? So obviously, whenever someone takes a loan, so even if I take a loan from a bank, you would say that I'm in loss because I have to return the interest with interest rate, but I mean, this is how loans operate. Okay. Now, this being said, students, government is taking a loan because government has to do something, build a new motorway, or uh, set up metro bus or public transport in any city of Pakistan, and so on and so forth. Right, exactly. In both cases, right. Whoever takes a loan has to pay interest. So, I mean, if you want to say that that person is in loss, I mean, I will agree with you, right? But yeah, this happens everywhere. Whether you take a loan from IMF, World Bank, or you raise it locally, that happens. Okay. Now, this being said, now students, listen to me. Now, listen to me. When bonds are issued, what happens, right? When bonds are issued, what happens in the market? This is known as open market operations. This is known as open market operations. Now, listen to me very carefully. Open market operation is basically the process. Let me write down the definition for you first and then move forward. Open market operations is the process. How is the process that explains how through use of bonds the government can affect money supply. Now, read this definition one more time. Can affect money supply, right? So students, let's read this again. What is open market operation? Open market operation is the process that explains how through use of bonds, the government can affect money supply, right? Okay, now we are coming to open market operations, and we will see that how when bonds are issued, that affects the money supply of the country. Now, let me explain you the process. There will be two steps. Issuing bonds, students, stay with me. Issuing bonds, and the second stage would be purchasing back bonds. So first time the government will issue bonds, obviously. Are you getting me or not? Issue bonds mean like the government will say that the bonds are available for the public to buy. That is what issuing bonds mean, right? And after some time, when the maturity has been hit, 1 year, 2 year, 5 year, obviously the people need their money back, right? That is known as maturity period, right? Then the government repurchase of bonds, right? So government will repurchase these bonds back from the citizens and pay them their money, right? This is how it works, right? That is what loan means. You take someone's money, you borrow someone's money for some time, and you pay back that money after the maturity date. That can be 2 years, 3 years, or whatever. Repurchase bonds, right? Students, are you clear on this? Right? Repurchase bonds. Okay. Now, students, have a look at this. Let's first think about the issuing bonds. Let's say I'm an individual, and there's so many other individuals like me. On one end, there is government. On one end, there is government that is issuing, bonds, and then in the middle, there's a bank, and the other side of the transaction are individuals or households. You guys know what households are. Households are like, people like you and me, all the people living in Pakistan. Now, when government issue bonds through a bank, normally it happens through a bank, and commercial banks, I mean, right? All these banks, Allied Banks and Standard Chartered and so on and so forth. So government issues bonds, right? And these people are taking these bonds, right, through the bank. Like, it doesn't happen directly. That is why I have put the bank in the middle, right? It doesn't happen directly. So I don't need to go to any State Bank of Pakistan or, any building. Where what I need to do if I want to buy government bonds, I just need to go and visit the commercial bank, right? So there will be a standee there, or I would have the information and I can buy that government bond, right? So government issue bonds through the bank, and the households buy that. Now, in return, what do households have to do? In return, what do households have to do? When you're buying bonds, what you're doing, students, think about this. Your bank account will be deducted by the amount of bonds that you have purchased. Your bank account will be exactly pay the government the money, right? So bonds are not for free, right? So households will pay the cash. So if I am one of the people who has bought the bond, then if that is worth 50,000 rupees, my bank account will be decreased by 50,000 rupees. So the cash will move from my bank account to the government account. cash will move from my bank account, cash will move from my bank account to the government account, right? Are you getting me? So in the first case, when cash is getting reduced, when the cash, I'm just talking about the issuing bonds at the moment. So in the first scenario, when the cash is moving from our accounts to the government account, what will commercial banks face? Commercial banks will face less of deposits. Commercial banks will be left with less of deposits. And when deposits in commercial banks are reduced because a lot of people have invested in government bonds, will commercial banks have more ability to issue loans, or will commercial banks, according to credit multiplier, or will commercial banks have less ability to issue loans? Students, are you getting me? That's a simple question. Less ability. Arbab, did you get this? Less ability. You got my point. Excellent, right? So it's a very simple and straightforward process. Government issue bonds, households buy bonds. When households buy bonds, they pay the cash to the government, right? And in the process, who is being affected? The commercial banks are being affected because all households have their account in the commercial banks. Government has its account in the central bank, right? So when money moves from commercial bank to the central bank, because government accounts are in the central bank and central bank looks after all the government transactions like Central Bank, State Bank of Pakistan. So commercial banks deposits have reduced. When commercial banks deposits have decreased, now they can issue less loans because the deposits are less. According to credit multiplier, the entire mechanism that we looked at, they will be able to issue less of loans. So whenever bonds are issued, right, money supply is reduced. Why is money supply reduced? Because loans are reduced. The ability of commercial banks is reduced. Money supply is reduced. How many of you understood this? So when for the first time commercial banks issue loans, the deposits of commercial banks is reduced, and deposits of commercial banks is reduced, right? So money supply is reduced. Easy? Is this simple? Any confusion about it? Got it? Okay. Now in the second scenario, everything is happening reverse. Everything is happening reverse. So let's quickly try to sum this up. Now, what would happen? The arrows would be in the opposite direction, right? So government is buying that bonds back. Government is buying that bonds back and paying, paying the cash to the households. Have a look at this, right? So bonds are coming back from the households after 2 years, 3 years, maturity date. I did tell you, right? So after that, the bonds will be coming from households to government, and government will be paying the cash to the households. Now that cash is back in my bank account. So 50,000, 1 lakh, whatever amount of worth of loans I had bought, worth of bonds that I bought, now that amount is back in my bank account. Now that amount is back in my bank account, right? So now when commercial banks have more deposits, what will happen to the money supply? What will happen to the loans that they will issue? Now, when the cash is back to the households, and where do households have their bank account? Their money is lying in the commercial banks. Now, when commercial banks have more deposits, the loans will increase, the money supply will increase, right? So money supply is increased again when government repurchases back those bonds. Money supply is increased. Money supply is increased. Students, are you getting me? So this is the entire thing of open market operations. This is the entire thing of open market operations, right? Easy? Any confusion so far? Anything that's not clear, students? Anything you want to ask me? Anything that's not clear, right? So we'll stop here for today. We will have no class for tomorrow. And then on Monday, we'll move from here. Right now, our target is to complete the syllabus as soon as possible. And then we'll come to the past paper practice, right? Okay, take care. Have a good night. Have a good weekend. I'll see you on Monday, right? At the usual time. Okay, take care. Allah Hafiz.